Hello, everyone. Welcome to At the Edge of Tomorrow, prepared with contributions and research from Yasar Atolye, where we discuss the intersections of technological and economic transformation. Today, we are delving into two important topics that could fundamentally change the financial world: stablecoins and asset tokenization. We have comprehensive studies from McKinsey ahead. Here is the future of digital money with stablecoins. From waves to storms, the transformative power of tokenizing assets. And a door is opening. How does tokenized cash enable next-generation payments? Articles with these titles. Our goal is to make these topics, which initially seem a bit complex, understandable for you. Why are they important? Why are they exciting? And what are their risks? We will look into these. Shall we begin?
Let's get started, of course. The numbers already seem to summarize the situation. You're talking about the stablecoin market, which has grown from $120 billion in the past year and a half to $250 billion. There are even estimates for 2028 reaching around $2 trillion. This is not something to be ignored. Tokenization is even a bigger picture. It feels like the infrastructure of finance is being rewritten.
Then let's start from the very beginning. When we say stablecoin, what should we understand? The famous price volatility of cryptocurrencies like Bitcoin that we all know. How are stablecoins changing this? Are they really more stable?
We started from a very correct point. Stablecoins are digital assets that aim to keep their value stable, as the name suggests. They are usually pegged one-to-one to a strong, well-known currency like the US dollar. That's what we mean by pegged. The basic idea is this: let's take advantage of blockchain's benefits such as speed, transparency, and low cost. But let's combine that with the predictability and stability of traditional money.
So, is it like the conveniences of the digital world and something like a price guarantee?
Yes, you're avoiding price fluctuations. The most popular examples are Tether USDT, also circles USDC.
I understand. So we use it in digital form, but its value is always $1. So is this stability on paper? How do they achieve this? What is behind this digital currency? Do they really hold dollars?
That's the key point. Collateralization. That is, for each stable coin they issue, the issuing institution must hold a corresponding real asset in their vault or a trusted place. For example, in the case of USDC, Circle says that for each USDC, they hold mostly around 90% in short-term US Treasury bonds or repo agreements, which are highly liquid and secure assets. The rest is kept in cash. This theoretically means that you can convert your USDC into dollars at any time on a one-to-one basis. They are trying to provide such a guarantee.
So is this actually not an abstract internet currency, but more like a digital cover wrapped around assets we know, such as bonds and cash, something that makes them programmable and quickly transferable?
Nice analogy. Yes, we can think of it that way. But we must not forget one thing. These are issued by private companies. Usually, they work on public blockchains, like Ethereum. So they are not yet official digital currencies of governments, the so-called CBDCs. That's why their regulations and oversight are still somewhat unclear. It varies from country to country. Of course, this also brings risks.
So putting the risks aside, what are the advantages of the current banking systems we know? Why should I or a company use stablecoins instead of a regular bank transfer? Is it especially beneficial for cross-border transactions?
Absolutely. Here, it addresses the two biggest issues of the traditional system: the slowness and cost of transferring money from one place to another, especially internationally. Also, the opacity in the process, meaning the lack of transparency, and dependence on many intermediaries. McKinsey articles have summarized these benefits into 5 categories. But fundamentally, they address these two main problems. The first is speed and accessibility. Now, let's say you want to send money abroad through a bank. It can take up to 5 business days, and you can only perform transactions when the bank is open. Stablecoins, on the other hand, operate 24/7 on the blockchain. Transfers are completed within minutes or even seconds. The second is low cost. In the old system, when money moves from point A to point B, It passes through numerous intermediaries like correspondent banks and clearinghouses. Each one takes a commission. Stablecoins largely eliminate these intermediaries. Costs can be significantly reduced. In fact, sources mention that some new generation payment companies can make cross-border payments at 1/5 the cost of traditional methods. The third is transparency and control. Since blockchain is a distributed ledger, every step of the transfer is recorded on a ledger that is generally viewable by everyone if the network isn't permissioned. This reduces concerns like where the money is or if it has been lost. There are also smart contracts, which can automatically handle controls like anti-money laundering or customer verification. The fourth is global access, which sometimes requires a lot of documents and procedures to open a bank account. Stablecoins mostly operate with a digital wallet concept. If you have internet, potentially anyone can use them. This is a very important potential for billions of people who do not have access to banking services. And finally, innovation. Since these are programmable money, you can build entirely new things on top of them. For example, conditional payments, automatic portfolio management, or instant payments with tokenized assets that we will discuss shortly. It opens the door to new business models.
It really looks like potential is broad. So, where is it currently being used the most? In which fields do we see this technology?
Several areas stand out very clearly. Cross-border payments and remittances are definitely the most popular. This is about migrant workers sending money to their families. Small international businesses, speed and cost are critical for them. Sources even say that by early 2025, 3% of the world's cross-border payments could be made with stablecoins. Even 3% represents a huge volume. The second area is trade finance and capital market reconciliation. In large transactions, say you bought shares, the money and the shares need to change hands simultaneously. That's where tokenized cash in the form of stablecoins is used, providing instant and secure reconciliation. Delays and counterparty risk are reduced. The third area is corporate treasury and cash management. Large companies are starting to use this to manage their funds in different countries more efficiently, monitor liquidity instantly, and optimize it. It provides operational convenience. Finally, it plays a role in completing the CBDCs we mentioned. That is, since the central bank's digital currencies are not yet fully widespread, we can say that stablecoins serve as a kind of laboratory for the private sector to experiment and gain experience in this field.
Understood. It seems that stablecoins are mainly targeting payments and money transfers, but I think there's a bigger framework to this. That is asset tokenization, and even BlackRock CEO Larry Fink has that ambitious statement. He says that every stock and every bond will be in a single ledger. What exactly does tokenization mean? Why is it being talked about as such a big deal?
Tokenization is actually very simple as a concept. You take an entity from the real world. It could be a house, a valuable painting, a company's stock, a government bond, or even the copyright of a song. You create a digital, unique identity for it on the blockchain. That is, a representation. We call this digital representation a token. Larry Fink's words also show how limitless the potential of this is. In theory, everything that has ownership can be tokenized.
So, is it like this? For example, dividing an apartment into small digital pieces and buying and selling them on the blockchain, or an artwork?
It indeed has such potential. Its benefits are actually very similar to stable coins. Operational efficiency, meaning paperwork, manual processes, errors decrease. Interoperability, different tokens, different applications can easily communicate, interact on the same platform, and programmability, things like automatic dividend distribution and interest payments with smart contracts can be implemented. McKinsey had an analogy that I really liked. Tokenization creates a giant digital vault, accessible from anywhere in the world, where assets don't move from their place. Ownership changes hands instantly. The entire history can be transparently tracked.
It sounds futuristic, but how much of it is real right now? Are we seeing examples of this in the market, or is it still mostly in the idea stage?
Absolutely. We've moved past the idea stage. Concrete examples are increasing, But of course, we're still at the beginning. McKinsey says that the market value of tokenized assets, excluding crypto and stablecoins, could reach approximately $2 trillion by 2030. In a best-case scenario, it could even reach $4 trillion. That is, a very significant growth potential.
So, which assets are in the foreground right now?
There is significant activity in several areas during the first wave. For example, investment funds, especially the tokenized versions of money market funds, are becoming popular. Giants like BlackRock and Franklin Templeton have entered this space. There are also Web3 companies like Ondo Finance. These tokenized funds have already surpassed $1 billion. What are the advantages? You can buy and sell 24/7, and perhaps in the future, you will even be able to use these funds for direct payments. The benefits of tokenization here are very clear. Names like Broadridge, Goldman Sachs, and JP Morgan have already started moving trillions of dollars worth of repo transactions to the blockchain each month. With smart contracts, collateral management, and margin calls are automated, errors decrease. Since transactions are conducted 24/7, capital is used more efficiently.
Interesting. Anything else?
A significant area in loans and securitization. Platforms like Figure Technologies or protocols like Centrifuge have already transferred billions of dollars in credit transactions onto the blockchain. What's the point here? More transparent credit pools, packaging and selling loans, and making the securitization process faster and cheaper. Perhaps this also means better costs for borrowers. There are also bonds. Cities like Siemens, the World Bank, and even Lugano have issued bonds in the form of tokens. The total issuance volume exceeds $10 billion. What's the benefit? Operational costs decrease. Savings potential of up to 50% is discussed. The issuance process speeds up. And most importantly, bonds can be divided into small parts and sold. This means more investors can access them. Fractional investing, in other words. Finally, the repo market should also be mentioned. Repo is that massive market where banks lend and borrow short-term collateralized loans from each other. Perhaps the most boring, but one of the largest markets.
The examples are truly impressive. The transformation seems to have started, but I'm sure this process isn't smooth. What kind of difficulties, what kind of risks are there? Especially traditional banks, what is the situation for them? Do they feel threatened?
There are definitely both difficulties and risks. One of the most obvious risks for banks is the deposit loss risk we just mentioned. That is, what will happen if people and companies start holding their money in stablecoins or tokenized money market funds instead of banks? The core resource banks use to lend money, that is, deposits, could decrease. Because the collateral backing that money is no longer in the bank. It is held by the company issuing the stablecoin or the fund manager. This could directly strike at the heart of the bank's business model. Of course, there are operational and technological challenges as well. Banks need to make significant investments to adapt to this new world. Building blockchain infrastructure, integrating with digital wallets, and training staff are not easy tasks. Additionally, legal compliance issues like AML and KYC could become more complex on the blockchain. New security vulnerabilities may emerge. In other words, operational risks and cybersecurity risks are also increasing.
So, what is the biggest obstacle generally preventing the widespread adoption of this tokenization? The sources mention something called the cold start problem. What exactly does that mean?
This is actually a classic situation faced by many new platforms. It's like the chicken and egg dilemma. While technically it may be easier to create tokens, there are not enough people to buy and sell these tokens, meaning no demand. And without sufficient trading volume or liquidity, the market doesn't pick up. When liquidity is low, no one wants to issue new tokens. Investors also don't want to enter. It's a vicious cycle. Early adopters bear the costs of the old system, and since the new system isn't yet efficient, they struggle. Of course, there are also major players who make good money from the current system. They can resist change as well.
I understand. This is the situation we see with these tokenized bonds. There is issuance, but trading is weak.
Exactly. To overcome this, McKinsey proposes a concept called MVVC, which stands for Minimum Viable Value Chains. It suggests that you cannot do this alone. From the tokenization of an asset to buying, selling, and storing, all key players, issuers, investors, exchanges, custodians, must come together from the start and agree, working together to establish this ecosystem. Initiatives like Singapore's Project Guardian or the Canton Network established by different banks operate precisely on this principle. Let's do it together so that this cold start can be energized.
So we need to act as an ecosystem. So why is it said that 2025 could particularly be a turning point while all these are happening? Why has the wind started to blow so strongly?
Several critical factors are maturing simultaneously, which is why. The things that make 2025 a potential breaking point are as follows. First, regulatory clarity is increasing. MiCA is officially coming into effect in the European Union. Stablecoin laws are progressing in the US. Centers like Hong Kong, Japan, and Singapore are also taking steps. This brings predictability to the sector. Large institutions can now take more confident steps instead of waiting to see what will happen. Second, technological maturity. Blockchains are now faster and cheaper. Scalability is improving thanks to Layer 2 solutions and similar technologies. Digital wallets have developed and become easier to use. Tools from companies like Chainalysis enable better transaction tracking and risk management. Infrastructures are becoming ready. Thirdly, increasing circulation and demand. We talked about stablecoin supply. It has doubled in 18 months. There is a target of $2 trillion. This indicates demand. Also, there is interest in those yield-generating tokenized funds issued by giants like BlackRock. Investors are now looking at these products. Fourthly, and perhaps most importantly, institutional participation and successful experiments. JP Morgan moves billions of dollars daily with its JPM coin. There are collaborations like Project Guardian and Canton Network that we mentioned. Central banks have projects like mBridge. These are no longer just let's try it projects. They are solving real problems. They provide tangible benefits. These successful examples encourage others. They say, it works.
Yes, it really seems like the pieces are falling into place. So in this situation, especially the traditional financial institutions and banks, what should they do? Should they sit and wait for this storm to pass? Or should they do something immediately? What should be the strategy?
McKinsey is actually saying this. Waiting is now very risky. When the signs of market maturation become clear, meaning when everyone starts entering, it may be too late to take action. The first thing they need to do is make a strategic decision. What role do we want to play in this new digital finance world? What kind of roles could there be for a bank? What are the options?
There are a few basic ways. Will they issue their own stablecoins?
They may protect their deposits, but this further fragments the ecosystem and carries its own risks. Perhaps a few banks could merge and launch a joint consortium coin. Or they might partner with one of the major global players, like Circle, and use their technology. Or they might buy ready-made solutions from large technology providers like Fiserv or FIS. Each option has its pros and cons. They need to make this decision first. After making this decision, the process accelerates. Finding or training talented people immediately, such as blockchain experts, smart contract developers, setting up the technological infrastructure, choosing the right partners, training senior management, engaging with regulators, and defining a clear market entry strategy. So the question is no longer whether to do it, but how to do it.
Indeed, the financial world seems to be on the brink of a major transformation reminiscent of the early days of the internet. Stablecoins and tokenization could fundamentally change not only money transfers, but also our understanding of ownership, our investment methods, and the entire architecture of the financial system. Today, based on the McKinsey sources we have tried to make this exciting yet somewhat complex topic more understandable for you. Perhaps one last point needs to be emphasized here. It is very important not to see these technologies merely as tools for cryptocurrencies or speculation. They could potentially become the new rails or operating systems of financial infrastructure. Of course, there are still unanswered questions, barriers to overcome, risks involved, but the potential benefits and the recent institutional interest suggest that this change may be quite irreversible. So, when all this technology becomes widespread and this new financial infrastructure is established, where do you think we, that is, individuals and small businesses, will feel the most noticeable and striking change in our daily lives? Perhaps the greatest impact will hit from a place we haven't even thought of today. Let's ponder this question until our next conversation. See you in the new episode of At the Edge of Tomorrow next week.